The next technique is predatory pricing. And what that means is we're going to temporarily drop prices below our marginal cost. That sounds stupid. Why would you ever do something like lower your price below your cost? You're doing that so there's big signals. Stay away from this market. So what we're doing in a sense is we're trading off our current profit and foregoing a lot of profit in order so our future profit could be restored and therefore we have longer term profits. And the firm engaging in this predatory pricing must have deep pockets because you may have to sustain these losses for a while to show the seriousness and really deter entry from anyone to come in. The counter strategy, if you're competing with this company, is okay, fine. You're dropping the price. I'll stop production. I'll let you supply the market. I'll cede the market to you. Therefore, you make more and more and more, knowing that with each unit you make, you're losing more and more money because there is no positive contribution from any sale. Secondly, I'll even make it more. I'll have the market buy from you and I'll buy from you and I'll stockpile the product because I can't make it cheaper anyway. So I just stockpile it, wait for you to give up. And when you do so, the right prices will rise and I'll use your own inventory to sell into market and make profit on your inventory that I bought from you. So those are possible counter-strike strategies for the other firm. There's also a big question about legality. It is illegal in the United States to do predatory pricing. It's viewed, rightfully so, as anti-competitive and quite extreme. The difficulty sometimes is these are complex and a lot of the information is inside information, and therefore trying it in courts is often difficult to prove the case against the monopolist. So some legitimate practices might be deemed predatory under the legal definitions. For example, if there's fierce competition with a lot of fixed costs, it might lead to the departure of the weakest firm. So this is really to raise the stakes in the game to prevent entry of anyone else. Second, firms attempting to penetrate with a new product often find it advantageous to sell at a low price or give it away initially. And this is now a very aggressive action from the new entrant who has a superior cost position and therefore they're taking on the giant in the business. So let's try out an example. So Baker, the same thing, has the memory chip. And if they're a monopolist, they make 10 million. We saw that previously at a price of 115. While Baker could have thwarted the entry by limit pricing in the prior example, it opted against doing so. Now it's stuck in a duopoly. Their earning is now $4 million a year. Here's the problem. If Baker drops his price to $68 per chip and holds it for a year, it will be able to drive out the other firm and retain its monopoly position once again. So over the year in which it engages, Baker will be losing $60 million. Ignoring legal considerations, is this a profitable strategy? At an interest rate of 10%, and let's assume that the profits occur immediately at the beginning of the year. Again, making the time value money math a little bit easier. So we've now moved on the story from Baker, where they did not do limit. They allowed the duopoly to occur, and now they're trying to drive out the new entrant in the business. The first scenario is Baker does not engage in predatory pricing, and what's the present value? So this is a base case. So 4 million plus 4 million divided by 1 plus 0.1, then squared, cubed, etc., leads to the present value of the profits for Baker at $44 million. If they do engage in predatory pricing and it all works out exactly as planned, they will lose $60 million this year, and then thereafter they'll have $10 million a year sustained throughout the future. So the present value of those stream of profits would be $40 million. So in this case, as painful as it is to have a duopoly, it may be better than engaging in a prolonged battle and thereby lowering the profits in the future for Baker. The next strategy is, can you raise the rival's cost to lessen competition? But depending on your market power and other things that you can employ, this may be possible. First, can we do something with the marginal cost so the competitor's marginal cost goes up? Second, can we do things with the fixed costs for the same end result? Or can we do something if we have a vertically integrated firm and we can now look at multiple markets with our actions? The first is going back to our reaction function, where we have two firms, 1 and 2, one being on the horizontal and 2 being on the vertical in terms of quantity of output. We have a Cournot oligopoly where the volume set in the market as it equalizes, will be at point A. So that, you recall, is the equilibrium point. So what would happen if we could make the rivals' costs go up, which makes the reaction curve less responsive? It's going to move down to this lower blue line such that you see that the equilibrium point will drop, thereby increasing the volume for competitor 1 and lowering the price so that we continue to drive up our volume but at a higher profit to firm number 1. We would then drop to point B, and that is an effect that is advantageous. So we're taking away volume from firm number 2, we're increasing the volume for firm number 1, and since we're on an ISO profit curve that's closer to the horizontal axis, that's a higher ISO profit curve, right? So we remember that we had ISO profit lines like this. At A, we're at this relatively high one, but as we move closer to our monopoly position, it's advantageous for us as firm number 1. So the end result is by driving up firm 2's costs, the reaction function has to go lower, thereby we increase the sales and profits for firm number 1. Next is, what if we can increase the rival's fixed costs? In this scenario, we have a license fee where we could be friendly with the government to say, oh, it's okay, why don't you charge everybody $90 for a license fee, knowing that your costs will go up. But the idea is your cost goes up, but so does any entrant that may enter your business. So let's look at this as a sequential game, and we're here, we're the incumbent. And if we do a license, we end up here, and then the new entrant has the idea of, do I enter or not? In this scenario, you do the 90, the entrant is looking at either -20 or 2. Not a very attractive opportunity, therefore they don't enter, and you make 110. Now, although 110 is less than 200, that is actually better for you. Why? Because if you say no license and just kind of ride it out, entry will happen. Once the entry happens, the opportunity for the entrant is the choice of 70 or 0. I think I like 70. So in other words, if you take this first step, the rival will look at the conditions and then enter, so they make 70 as opposed to 0. So you essentially have opened the door. What we see here is we have a sub-game perfect equilibrium. By you preempting any action by the rival, by having the cost rise, the rival will look at the conditions. It all of a sudden does not look like a profitable situation, and they do not enter. So again, you recall in our game theory chapter that this is a sub-game perfect equilibrium. Notice this is different from what would happen if you did a simultaneous or a one-shot game. Having the first move be very visible presupposes the action that will happen from your rival.